Most people think the middle class is the safest place to be financially. But did you know that over 60% of Americans are living paycheck to paycheck? And the average American household only has about $400 in savings for an emergency. That's a scary thought when you realize that one unexpected event, like a car repair or a medical bill, can send you into a financial tailspin. The truth is, the middle class is stuck in a cycle of earning, spending, and saving, without ever getting ahead. But here's the good news: you can break free. What if I told you there's a way to escape this trap and build real wealth? In this video, we'll dive into the 6 key paths to financial freedom, starting with how value investing can unlock opportunities most people miss. You'll learn how to identify undervalued stocks, use compounding to your advantage, and even think like the wealthy to make smarter financial decisions. So, if you're ready to stop playing catch-up and start building your future, stick around. This is your ticket to escaping the middle-class trap. Chapter 1. Breaking Free. The hidden power of value investing. The world of investing can feel like a maze, especially when you're stuck in the middle-class cycle of just saving and paying bills. But here's the secret: value investing isn't just about buying stocks, it's about creating wealth by thinking long-term. Value investing is often misunderstood, with many thinking it's too complicated. In reality, it's all about buying stocks that are undervalued by the market. When you buy companies at a bargain price, you unlock long-term wealth. Warren Buffett, one of the richest men in the world, says, "Price is what you pay, value is what you get." This quote sums up the core of value investing. By focusing on the value of a business rather than its stock price, you can make smarter, wealth-building decisions. It's a simple idea: buy low, sell high. But the key is knowing when a company is undervalued, and that's where the magic happens. In fact, research shows that value stocks tend to outperform growth stocks over the long run. So, how can you start? The first step is understanding what makes a company valuable. Is it the leadership? The market they're in? Their financial health? Value investing is about patience. You're not looking for a quick win. You're looking for solid companies at a fair price. And when you find one, you hold on for the long term. Chapter 2. Undervalued gold mines. Finding hidden gems in a sea of stocks. Finding undervalued stocks isn't about luck. It's a skill that can be learned. There are thousands of stocks out there, and some of them are like diamonds in the rough. But how do you spot them? One strategy is using the price-to-earnings (P/E) ratio. The lower the P/E, the cheaper the stock might be compared to its earnings potential. A P/E ratio of 10 or below is often a sign that a stock is undervalued, especially if the company is growing steadily. But remember, a low P/E doesn't always mean a good deal. You need to look deeper. Another key metric is the price-to-book (P/B) ratio, which tells you how much investors are paying for a company's net assets. A P/B under 1 might indicate that a stock is trading below its actual value. Buffett also says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This reinforces the idea that value investing isn't just about finding any cheap stock, it's about finding a cheap stock of a great business. So, focus on businesses with a strong competitive advantage, like Coca-Cola or Apple, which dominate their markets. Chapter 3. The power of compound wealth. Time is your best ally. One of the most powerful tools in value investing is compound interest. Albert Einstein famously called it the 8th wonder of the world. The concept is simple: your investments grow not just on the money you've put in, but also on the returns you've already earned. For example, if you invest $1,000 at an average annual return of 7%, after 10 years, you'll have $1,967. But after 20 years, that same $1,000 grows to $3,869. It's not magic, it's the power of compounding. The earlier you start investing, the more time your money has to grow. It's why it's so important to invest consistently and early, even if the amounts are small. The best part? Value investing plays right into this. When you invest in undervalued stocks with solid fundamentals, the returns accumulate over time. You might not see huge gains immediately, but with patience, those returns will grow exponentially. It's a slow, steady process, but it's one that leads to lasting wealth. If you're enjoying this content and want to learn more about escaping the middle class trap, don't forget to subscribe and hit the bell icon to get notified about our future videos. Chapter 4. Risk and Patience. The unspoken secret to investing like the 1%. The middle class often avoids risk, but the wealthy understand it. They take calculated risks, knowing that long-term gains often require a little short-term discomfort. The stock market can be volatile, but that's where value investing comes in. By purchasing undervalued stocks, you're reducing your risk. These companies tend to be more stable and resilient, especially during market downturns. In fact, research shows that value stocks are less risky than growth stocks in the long term. A 2017 study by the Journal of Financial Economics found that value stocks have lower volatility and provide higher risk-adjusted returns. The key to success, however, is patience. Investing like the wealthy means you don't panic when the market dips. You wait, and you let your investments grow. As Buffett says, the stock market is a device for transferring money from the impatient to the patient. The wealthiest investors are patient, and that patience pays off. You may not see results immediately, but over the years, the compound growth of your investments will add up. Chapter 5. The Mindset Shift. Thinking like a business owner, not a consumer. Most middle-class investors view the stock market as a way to get quick returns. They're focused on the daily fluctuations of stock prices, which can lead to poor decisions. However, value investors take a different approach. Instead of focusing on the stock price, they think like business owners. When you buy stock in a company, you're buying a piece of a business. Great business owners don't worry about short-term stock price movements. They focus on growing their businesses for the long term. This is the mindset shift that helps you escape the middle-class trap. For example, Buffett once said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." He's stressing the importance of long-term thinking. If you wouldn't want to own a company outright, why would you buy stock in it? Shift your focus from being a consumer of products to an investor in businesses. When you think like a business owner, you make better, long-term decisions. Chapter 6. Building wealth beyond stocks. Creating a portfolio of financial asset. Value investing isn't just about stocks. The wealthiest people diversify their portfolios to spread risk and maximize returns. While stocks are the most common investment for value investors, there are other opportunities to build wealth. Real estate, for instance, offers a great way to generate income and build long-term wealth. Buffett himself has a large portion of his wealth tied up in private businesses and real estate. You don't need to be a billionaire to invest in real estate either. REITs, real estate investment trusts, allow anyone to invest in real estate without owning physical properties. They offer a way to get exposure to real estate markets, earn dividends, and benefit from property value appreciation. Bonds are another important asset in a well-rounded portfolio. They're generally safer than stocks, but they still offer potential for returns. By combining stocks, real estate, and bonds, you can reduce risk and create a stable financial foundation. In fact, studies show that a diversified portfolio tends to outperform one that is heavily invested in a single asset class, such as stocks. A balance between growth, income, and stability is essential for long-term wealth. So, while value investing in stocks is a great way to get started, don't stop there. Expand your portfolio to create financial security for the future. If you found this video helpful, be sure to like, subscribe, and click the notification bell. We have plenty more strategies to help you build wealth and escape the middle-class trap.